Would you like to see if you're on track to reach your financial goals? Did you know there's a simple tool you can use to figure that out really easily and quickly? That's what I'll be showing you in this video. Hi, I'm Camille Gaines, founder of FinancialWoman.com and author of Earn, Grow, Give. I'm a financial coach for women and I teach about investing and income. And recently I did a video on how to use the calculator at FinancialWoman.com. I'll put the link below, but in case you want to look at it, it's FinancialWoman.com/investment-calculator. So the link's below, and you'll want to check out that video here on YouTube because I show you exactly how on my computer I use an investment calculator. I've got a video that shows how you can take $250,000, how it grows to over $1 million. And so that video, I had several questions and interest about, well, you know, this is really, really great and helpful. I'm not sure exactly what to put in this field or that field, so I decided to do a series of videos for you guys telling you exactly how to use that investment calculator. Now, remember, investing and using the calculator, it's all about estimates and probabilities. A lot of people feel like they have to know the exact numbers, and so they don't do anything. They don't use it. Remember, investing is about probabilities and estimates. It's about giving it your very best guesstimate, I call it. And so don't let perfection, having to feel like you have to know the exact numbers, keep you stuck. Because if that happens, then you just won't move forward. What I want you to do is give this your best guesstimate. And I'm going to talk about the third field on that investment calculator. And so the first one was how much money that you have in your investment account. The second one was how much you're going to add every month or year to that investment account. And now this third field is called interest rate. Okay, so the first thing I want to say is interest rate is really a little bit of a misnomer. That really, I would like for it to be called more appropriately a return on investments, because it could be interest rate, right? If your money's sitting in a bank account and it's earning only interest. It could be interest rate if your money's in bonds and you're earning interest on those bonds. But if you're invested in the stock market and you're getting a return on your investment, which you've probably heard me talk about in other videos, then that term would more appropriately be called return on investment. So think of interest rate as whatever your money's going to earn for you, right? That money's working for you in an investment account, whether it's interest or whether it's growing and compounding, whatever it is, it's increasing, however it's increasing in value. That's what you're going to think about. So don't be confused by interest. That's point number one. So whatever your money is earning in your investment accounts, that's what's going to go in that field. Now, point number two that I want to make about this is, wow, nobody knows, right? If we all knew how much we're going to make in our investment accounts, well, we would be gazillionaires and we wouldn't even be worried about this. So nobody knows for sure. But what we do, and what financial advisors, financial planners do, is they use, again, the best guesstimate, and that's based on what markets have done in the past. So if you're in the stock market, for example, over a very, very long period of time, over 20 years, you can expect a positive return. And the number that's generally used over a very long period of time in the stock market, over 20 years, is around 6 to 9%. Now, Warren Buffett said use about 6% for the stock market return over time. You know, other periods of time, the stock market has earned much greater. If you happen to catch the beginning of an up market, a really strong up market that lasts for several years, then your investment account might earn 20 or 30% a year. But if you hit a really, really rough patch like we did in the early 2000s and again in 2008 when the market tanked 30, 40, even 50%, then, you know, your return could be negative over a shorter time period. So nobody knows what this number is going to be. And that's the trickiest thing about using an investment calculator. Having said that, give it your best estimate. Point number three I want to make is be conservative in your numbers. Don't put down that you're going to get a 30% return or 40% return. Be conservative, because that way if you use a number that's really conservative and the market takes off and you do really fantastic and beat your guesstimate, then you're going to be really happy. But if you put in a higher number that's not realistic, then you could run out of money one day. And so this is a really important tool and a really important little exercise for you to take. If you're investing for a really long period of time, then I would use between 6 and 9%. That's over 20 years. If you're investing for a shorter period of time, I honestly think you have to consider where we are in the market cycle and ask yourself, has the market gone up, straight up for 5, 6, 7, 8 years? As of the time of this recording, it has been going up for 8 years. So I don't want to tell you that, you know, you could safely use an estimate of 6 to 9% in your stock account as a best guesstimate if the market's been going straight up for that long a period of time. And so use good judgment, and, you know, believe it or not, if the market has dropped by 30 or 40%, then it's more likely that the market's going to go up by 10, 20, 30% simply because it's coming back off the bottom. It's impossible to catch those tops and bottoms, but you have to have an awareness of it in order to invest safely. So that's what I wanted to share with you in this video. In summary, there's no easy answer. You have to just give it a really good estimate of what you think you can return in your accounts over a long period of time, over 20 years. A well-diversified stock or bond portfolio has returned between about 6 and 9%, depends on how much you have in stocks, how much you have in bonds. And also just know that if you factor in or even consider, what's gone on in the past few years in the stock market, that can be a really good clue for you to be more reasonable and realistic in your estimates of what it might do over the next few years. So now you know how much that you put in the investment column, how much you're going to save, and now you know about how much you can put for your what's called interest rate or rate of return into the calculator. I'll share with you in my next video what to do, what to put, or guides or ideas to put in those next few blanks on that calculator. I want you to use this tool. It's fantastic. And if you like this information, you find it helpful, check the little hands up, please. Let me know you like it. That would make me so happy. And if you shared it with somebody, well, I would just be ecstatic. Thank you.